Well, in the past 3 weeks, Nasdaq 100 companies have been reporting results that have either felt investors' wrath or love, depending on whether or not they've been good or bad. In fact, companies have swung up or down on average more than 5% immediately after reporting results. This is the MoneyMakers. I'm Bruce Whitfield. Tonight, I speak to the money managers about the South African context and try to ascertain whether or not South African investors also reward or punish companies to the same extent. It's, I suppose, the return of the good, the bad and the ugly and the very tall. I'm joined by Vestact Sasha Naryshkine, Nic Norman-Smith from Lentus Asset Management, Clivera-Inc.'s Clive, Ramathibela-Smith and Gary Booysen from Rand Swiss. That's the end of the show because the introductions were too long. Gary Booysen, I mean, look at MTN's results today. Market flat, but we tend to respond rather than to results as in US reporting season, we tend to respond to trading updates. That's where we get our knee-jerk reactions from, surely?
Yeah, no, 100% accurate. I actually did a bit of research before the show.
Well, no, that's a
we are the guys.
Bravo.
And on average in the latest...
1 out of 4 is not bad. Sorry.
So what we found out, about a 5% reaction in this current earnings season to trading statements, only about a 2.7% reaction to actual earnings announcements.
Okay, so a similar response. Now, analysts, investment analysts, Clive-Ramathibela-Smith, are supposed to be very clever. They're supposed to spend their time immersed in companies. They're supposed to know the companies better than the people who manage the companies. Why these knee-jerk responses?
It's simply the fact that we know where to put the money better than the people that actually work for the companies that we make money for. So the truth of the matter is, I mean, we saw it with Barclays, didn't we? Barclays Africa as well. Not really great, but did it do much of an impact on the shares? I don't think it did. So the response is a bit lackluster when it comes to what happens with the results versus what is actually happening in the real market. So I think that maybe as technology advances and hopefully the JSE one day will allow us to do better things faster to get impact onto the stocks much quicker and much responsive. I'm talking about algorithms here, guys. Algos, yeah. Algos. So what that will do then is maybe, because I mean the American market is really quick and fast, so it responds to anything. So maybe then we'll see a better response.
I think Clive's being a bit unfair, Sash. I mean, we look at Nedbank's results yesterday, for example, a classic example of better than expected results. There was no trading update, I don't recall, out of Nedbank because there wasn't the 20% threshold up or down.
10 down, I think, 20 up.
There we go. You would know it, and I expect you to. Well, then you get a point. But you know, the Nedbank share price massively strong on the day, and that shows that there is, I suppose, a good management and a good flow of information.
Yeah, people forget Mike Brown's almost been a lifer there. I mean, he was appointed CFO when he was 38, huh?
Yep.
In 2004. So he's part of the new era after the dimension data era was kind of gone. So I think he's done great work there. But I think back to your point and maybe trying to tie in what Clive's trying to say, there are a lot more participants in the US market, an enormous amount. And Nick and I have made notes here.
Wow.
I mean, Twitter trades 3.5% of their market cap or shares in issue every day. Is that just dumb or too liquid?
It's madness. The liquidity is insane, isn't it?
Apple trades 0.82. Yesterday, Apple traded 2.2% of their market cap. Here we got the world's biggest company by market capitalization, all because some idiot said it crossed a 200-day moving average. There's some guy tweeted, everyone's left the store here in New York because Apple's trading below their 200-day. They just stopped buying iPhones.
Yeah, no, but it is nuts. I mean, markets are crazy places. Volatility is a good and delicious and gorgeous thing, is it not, Nic Norman-Smith?
Absolutely. And the reality is, talking about forecasting, I mean, there's reams of statistics. The future is just very hard to forecast. So there's nothing against there's nothing against the the analysts sitting there getting it wrong. It's just it's very tough. There are so many moving parts. And if you look at the stats, obviously America, the analyst community and the numbers that are out there are a lot more. There's a lot more volumes of it. And how badly wrong these analysts are, even as much as a week or two before, is just
it goes back to the question, Sasha. We've had the discussion on the show before. Why bother paying the analysts anything if they're getting it so wrong?
Because we won't have a job.
No. All right. Other than that,
well, what was the joke? The world of financial analysts, or the world of the equity markets, is commanded by 20-something-year-old people who write 300 pages, of which 50-year-old people who allocate money never read.
Yeah.
But those reports, if you've ever read them, they're extremely in-depth. And how are they going to know in 2018 how many iPhones Apple are going to sell? Really? So they're just making projections.
Human beings want a 300 ream piece of information because then they feel better about themselves. The reality is no one knows. But also remember, on the sell side, what's called the sell side, these analysts are paid to generate brokerage revenue for the investment banks, not to tell you whether you should buy or sell. So quite frankly, that's not their job anyway, although no one could really admit it.
No, okay. So Gary Booysen, I mean, we look at it and we say, right, markets will make a price, and the price is you pay your money today and you get the stock. You could have bought Kumba Iron Ore 18 months ago at $500 a share. There wasn't anybody forecasting, was there, that you could get them today for less than 100.
No, I take your point, but again, it depends on the type of company that you're looking at. Kumba, it has a lot more inputs than some of the other companies. I mean, if you slave to commodity prices and you've got a falling iron ore price, yes, it's very difficult to factor that into a forecast. I mean, I hear what you guys are saying, but let's take it to like the absurd level. Let's take all analysts out of the equation. What happens then? I mean, then it's just anarchy. I mean, you have to have some sort of planning and some sort of valuation on companies. I mean, sure.
Yeah. Do you, Sasha?
Yeah, absolutely. No, I think you do. I think you've got to read everyone, because there are people who will tell you that, Doug Cass, so he's a great shorter of the market. He debated Warren Buffett on why Berkshire he thought was a sell. He was wrong. I mean, he's been saying it on Apple too. He's right for a little bit, but I don't know what his time frame is. I don't know whether it's 1 week, 1 day, 1 hour. I don't know. So a lot of people in the very short term, Carl Icahn, he's another one. You'll say absurd things like, "Oh, Apple's worth $210 a share." And you're like, "Well, what does that make them, a $1.5 trillion company?" Thanks, Carl. But I mean, he's one of the biggest shareholders in the business. So if he's not selling and he's still acquiring, well, then I guess that tells you what his time.
If you're taking a long-term view, you do need to understand, as Sasha said, what is everyone else's view? Because I can sit here and say, "Oh, well, I think this company's really cheap." Even if I disagree with the analyst report, it's probably quite interesting to know, he's concerned about that. Then I can make up my mind. I agree or disagree with him, but at least I know the information, as opposed to this something on the horizon.
No, but sorry, Gary, yes. And
what about survivor bias, though? Analysts that consistently get it wrong lose their jobs as well.
Yeah. Yeah, that's the consequences, though.
Is that a good thing?
Because they always say, the angel is always in the details. So
okay, now you guys have all got privileged access and time, because it's your day jobs, to read analyst reports. In the real world, occupied by doctors, dentists, bricklayers, and other people who have real jobs, and actually do things, they don't have time for that, and they don't have access to those reports. So what barometer should they be using to better forecast market movements? Directors' dealings. That's publicly available information. If directors are buying or selling, you would have got wrong if you followed Famous Brands directors in the last 5 years. But is that going to be a more reliable, publicly available piece of intelligence for you, Clive?
We have a serious problem with that regards to, and I was talking about it as well, about the fact that information is very hard from companies to really to take it down to the rest of the members and the people, and maybe we might solve the problem with our unions, because if everybody understands that the commodity prices are going down, then we won't have to have a strike. So the information, I don't think, is made simple enough for guys to understand the circumstances. So you are really using your paycheck as information with regards to where next to invest if the company is doing well.
No. The best any form of information on a company is its annual report. That is free. Obviously, you need an internet connection to download it. You can visit the company's headquarters, and they'll give you one for free. Warren Buffett read the IBM annual report for 50 years before he bought a share. Every single one, year after year after year, before he bought a share.
Yeah.
That's what he enjoys doing. That's his hobby. If you're an investor, that information is available to you, and it's free. It tells you everything about the company.
And it also takes away the short-terminism that many people
Quarter-writers.
Quarter-writers, half-writers, completely wrong all the time.
Weekly writers.
But maybe that's a great strategy, Gary. I mean, it's a case of taking the long-term view, taking the helicopter view of the company. Do I like what this company does? Do I believe it's got a sustainable business model? Will it go through cycles? Is it dependent on fluctuations in commodity prices? Is it dependent on consumers? I'll understand it better if I do some work.
No, definitely. I think understanding a company is always going to be a benefit, but it goes back to your point. If you're doing real work, then you don't have time to read these 40, 50-page corporate
reads
reports.
them at night in the bath.
But then don't make the
Have you ever
decisions.
taken one into the shower?
But you do still get consensus forecasts available on most companies. And you can see, and like Nick was talking about the sell-side analysts, these guys, if you go and speak to a sell-side analyst, these guys know these companies backwards. They know everything about the company. And yes, and they try and distill it to buy, hold, and sell. And you can use those rankings. I still put a lot of faith in those.
Okay, so you still put it back, and you can get that stuff also on the internet.
That's free. You can pull that.
You can simply Google it and get an opinion.
Put zero,
all three of them.
Zero faith on those, given statistically how wrong they are. You need to make your own opinion and then go and have a look and see where the market is and what people are saying. And so, use that as an input. So use the forecast as an input, use the reports as an input.
I think these two guys' time frames are world apart. That's why one would put none on it and one would put everything on it.
And that's the point.
Yes.
Okay. There's another elephant in the room, though, especially in the South African market, and what we've seen of late, is information that's not available to everyone. So we've seen a number... insider trading.
Yes.
So we've seen a number of companies that have seen movements in their share price on zero news. The news comes out, and well, if you want to do that statistical trading statement or whatever analysis, well, there's no move because
the mere fact that people still think they can get away with it. There's a guy upstairs who has smoke coming out of his ears on most days called Peter Redman. He was wraparound glasses. I forget which floor. But I mean, he has been very, very busy recently. Very busy recently. In terms of you watch those movements, and there've been a number of them.
Well, there's some examples. I'm not saying these were insider traded, but these are suspicious, and we haven't heard much more. So the Tsoko Sun HCI deal, where they were going to buy into Sunwest Casino. We saw both those share prices drop off by about 20% on no sense announcement. Tsoko had over a month. Tsoko had some results that maybe weren't great, but it's not like it suddenly moved on that. Sun had zero movement. Then we had a trading statement, a SENS coming out saying, oh, actually the deal's off. The share price, I think, maybe moved 1% on the day. This was a major market moving event in those companies' lives. Iliad, the share price moved right up, almost to exactly the bid price from Steinhoff. It just needs to be looked at.
Or we can take, absolutely, we agree. We'll get Peter Redman, we'll call him down for you.
This is South Africa's Harry Mokopoulos.
Or we could take the Jeremy Thomas from Business Times, long tried and tested way of doing things. Beginning of the year, take the share price page, get your kids some darts and throw them at the darts.
No, I don't think so. I mean, you can ask your kids, maybe, your kids are probably too young. Gary doesn't have any yet, Clive?
Okay, your kids are the oldest.
But you can ask them simple questions.
What do you like?
I mean, my youngest daughter thinks Nestle is the best company ever because they make Milo and chocolate milk, Nesquik. It's like, what can be wrong about this company? It's fabulous.
They call it science. These guys get paid the big bucks to make crucial investment decisions sometimes on your behalf. But it just does to go to show that there is a quagmire out there, not only in the publicly available information, but in the information which is used, which is not available to you and me. But ultimately, if you're in it for the long term, take the Buffett approach, read the annual reports and take your time. Nic Norman-Smith from Lentus Asset Management, Clivera-Inc.'s Clive, Ramathibela-Smith, Gary Booysen from Rand-Smith and Vestact Sasha Naryshkine. Gentlemen, thank you very much for joining me, and thank you for behaving mostly. More money making and money talking tomorrow night with other money makers. Till then, good night and goodbye.